Hello and welcome to this video on our monthly forecast meeting. Once a month I discuss with my economists and strategists whether our forecasts are still okay. This time we spent quite some time on the question whether the US and Eurozone GDP will still contract. In the US in particular, there are no signs of an imminent recession, but the Fed has raised its key interest rates massively. The US yield curve is inverted and banks have tightened their lending standards. We have therefore not cancelled the expected dip in US economic activity, but postponed it until the second half of the year. The lead time of monetary policy with regards to GDP is anyway variable. Turning to inflation, it has already peaked in both the US and the euro area and should continue to fall this year, mainly because energy prices are unlikely to rise again so quickly. But we have taken the forecast for core inflation, excluding food and energy, up a bit, especially in the euro area. This is mainly due to the weighting scheme used by the statisticians to weight the price increases of individual goods. Following the lifting of corona restrictions, people are again spending more money on services. Their weight is now rising. At the same time, however, prices for services are rising at an above average rate. This increases core inflation. The GDP contraction comes later. Core inflation is somewhat higher. Accordingly, we now expect the ECB's deposit rate to peak at 3.5% rather than 3.25%. The US Fed is likely to raise the upper limit of its interest rate range to 5.5%, previously 5.25%. These forecast changes do not alter the fundamental picture for financial markets. Falling inflation and the expected end of the rate hike process in the US and in the Eurozone continue to suggest that 2023 will be a year of relief on the financial markets.